Nigeria is set to get about $3.3 billion from the International Monetary Fund's special drawing rights allocation. The Board of Governors of the IMF approved a general allocation of special drawing rights equivalent to $650 billion. The allocation of SDRs will become effective August the 23rd. According to the statement, the newly created SDRs will be credited to IMF member countries in proportion to the existing quotas in the fund. About $275 billion of the SDRs of the allocation will go to emerging markets and developing countries, including low-income countries. Joining us to discuss further is Damilola Akinbami, who's the head of research at Financial Derivatives Company Limited. Damilola, good morning to you. Thank you so much for joining us.
Good morning, Rotus.
Great to have you. So I guess, how does the SDRs, let's start with that, and the IMF, what's the impact as far as the global economy is
Okay, so first of all, the SDR, special drawing rights, so it's not a currency. It's a supplementary foreign reserve asset that is maintained by the IMF and made available to member countries. And it consists of about 5 global currencies. So that's the Japanese yen, the British pound, the euro, the US dollar, and the Chinese yuan. Now, with that said, the IMF board, they've approved about $650 billion for global economies, out of which about 275 billion would be allocated to emerging and developing markets. And basically what this is expected to do is to boost liquidity and improve the external position of economies. We know that as a result of COVID, a lot of countries are struggling basically with high debt burdens. They're struggling to finance their urgent balance of payment needs. They're struggling to even spend and provide stimulus packages to support the growth recovery. And this is coming at a time when a lot of countries are experiencing third wave of the COVID pandemic. Some are even experiencing the fourth wave, and with the Delta variant, which is more potent and severe, definitely countries are in need of more funding. And so this is coming at a time that, it should support or help fast-track the recovery process. And bear in mind that the IMF retained its global growth forecast for 2021 at about 6.6%, while the IMF revised downwards its forecast to 2.2% from 3.4% because of this concern of a third wave of the Delta, of the COVID virus and pandemic. So we expect that at least this should put the global economy on track in terms of its recovery process.
Great stuff. So that's positive. All right, so that's the global economy. What about here in Nigeria? What's the impact for us?
Yeah, so for Nigeria, out of that $650 billion, Nigeria has been allocated $3.35 billion. And like I mentioned, obviously it's going to improve the external position. And for Nigeria, that's a good thing, bearing in mind that one of the major challenges the country has been facing is dollar illiquidity. And as a result of that, the CBN has come up with several exchange rate management policies and controls just to address these dollar shortages, ranging from introducing the Naira for dollar promo to forex rationing to mandating exporters to remit their proceeds officially through official channels. So definitely all these have been put in place just to address that illiquidity and whatever, and to offset the shortfalls we are seeing from our forex supply sources. So, for instance, oil proceeds, despite high oil prices, because Nigeria hasn't been able to ramp up its oil production, oil proceeds are declining. If you look at the first 5 months of the year, Nigeria's oil proceeds fell by almost 50%. We know that diaspora remittances, which is another source of forex, are down about 20% in 2020. We also know that even if you look at non-oil exports, for instance, cocoa hasn't been able to benefit from the commodity price rally that we've seen in the global market. And the other option is Eurobond proceeds, raising money from the Eurobond market, which the government is contemplating. So for Nigeria, an improvement in your external position definitely will impact favorably on the exchange rate. And if you look at the determinants of the exchange rate, you're talking about your current account balance, you're talking about your balance of trade, you're talking about your terms of trade. All these variables have been in a deficit, have been in negative position because of weak external imbalances, because of low forex supply, and that has affected the exchange rate's stability. So for Nigeria, it's a good thing. It will help boost external reserves, which we know has been increasing now. They're around about $33.5 billion. So if you add the $3.35 billion to the anticipated $3 billion Eurobond issue that the government wants to raise, that would be about $6.35 billion. So that would definitely impact positively on Nigeria's external reserves and would also support the exchange rate.
Great stuff. Okay, so since you've mentioned the Eurobond, Rwanda, $620 million, 10-year bond. I guess, and with Nigeria also looking to tap. Well, how do you look at the whole, spots in the African continent tapping the Eurobond market?
So a lot of African countries are tapping or going to the Eurobond market to raise funds because as a continent, Africa, in terms of volumes, didn't really record as much COVID infections compared to other continents. But in terms of impact and severity, we were the worst hit. So, and prior to this COVID pandemic, which started late 2019 to 2020, a lot of African countries already had high debt burdens and they already had a high debt stock. They were battling with other diseases. So, for instance, the Democratic Republic of Congo and Guinea already were experiencing a second wave of the Ebola virus. So a lot of African countries already had issues that they were battling with. Now COVID came, and most of them don't even have the infrastructure to even address and mitigate the spread of this virus. So definitely African countries are in a weaker position in terms of fiscal and external balances, and that's why we're seeing a lot of them. So far, at least in the first 6 months of this year, about $12 billion has been raised from African countries at the Eurobond market, and we know that at least 6 African countries have gone there. So Rwanda, 620 million. Ghana has been raising significantly, recently raised about $1.65 billion. Kenya too raised about $1 billion, and Nigeria that is planning on raising about $3.3 billion in this quarter. So definitely with this, we expect that it would help improve the external position of these countries. But the major risk about raising Eurobonds or going to the Eurobond market is, okay, what the threat to the success of that issue, and what a lot of investors are looking at is, okay, what's the risk premium? And if investors perceive that this country is a high risk, that would affect the appetite for the instruments. And take, for instance, Kenya. The 3 global ratings agencies all downgraded Kenya's credit status due to fears of debt accumulation, political instability, and what have you. And if your credit rating is downgraded, it will make it more difficult for you as a country to raise funds from the Eurobond market. So for Nigeria now, that's why we're seeing the policy authorities in Nigeria basically dancing to the tunes. We're seeing them doing some of the right things, saying some of the right things. So, for instance, we're seeing that Naira convergence at the forex market. We're hearing them talk about cost-reflective electricity tariffs, removing subsidy. All basically they're just trying to prepare the grounds for when they go to the Eurobond market. Because if investors see that, okay, you're doing the right things or you're taking the right steps, then it will make your instruments attractive. So that's what we're seeing right now.
Great stuff. Very in-depth. Thank you for that, Damilola. Okay, since we mentioned Nigeria, just real quick, I guess an exchange rate review in your turn, how you see things following the CBN's move to end FX sales to BDCs.
Yes, so immediately after the announcement, obviously we saw a plunge or a sharp depreciation in the Naira, especially at the parallel market. It touched 525 Naira to $1. But since then, we've seen a gradual appreciation. Right now, at this morning, Abuki FX was put the exchange rate around 508 to $1. So clearly, what we're going to see down the line in the short to medium term is a convergence of the multiple exchange rates around the IFX window. And that also, for that to happen and to be successful, the CBN also needs to increase its supply in the market. So at least with the ban to BDCs, so that supply shifts to the banks. So the public would have more access to dollars from the commercial banks. Obviously, they have to face the rigorous and cumbersome documentation process, but then still, at least the fact that supply is more available, and if there's supply, obviously that would impact positively on the exchange rate. And we're also seeing even the IATA exchange rate, which is the exchange rate which airlines use to price their tickets. We've seen that move from 460 Naira to $1 to 413 to 412, all within the space of about a couple of days since that forex ban. So we expect that Naira convergence to occur in the near term, but also the CBN has to increase supply, because if that doesn't happen, then we could see increased volatility occur in the forex market.
Great stuff. Damilola Akinbami, Head of Research, Financial Derivatives Company Limited, SDR, special drawing rights, Eurobond, tapping, exchange rate review. Thank you so much. Appreciate your insight.